Hello, good day everyone. My name is Ron from International Trade Council. You will start our webinar for today. Anyway, we are just going to do the introduction while we are waiting for the other participants to log in. Just for a few reminders, the presenter we're going to finish the slides first before he answer questions. If you will see the on the upper left side of the screen, there is a Q&A tab. If you have some questions, please feel free to type in your question there, and our presenter will going to answer the questions after the PowerPoint presentation. Our topic for today is global demand and credit insurance in COVID time. Our presenter is Mr. Gary Mendel. He is the president of Meridian Finance Group, a company providing credit insurance and trade finance tools that companies use to expand their US and international sales. He is a graduate of the University of Pennsylvania in 1976, and Gary has over 40 years of experience in domestic and international sales, distribution, credit, and finance. Prior to Meridian Finance Group, he held positions managing US and export business development for companies in the pharmaceutical, aerospace, and plastics industry. Gary has received the President's E Award for promoting international trade and currently serves on the federal government's Trade Finance Advisory Council. So I will give the floor to the presenter right now for him to start his presentation. Go ahead, Gary.
Thank you. You can hear me all right?
Yep.
Okay, so hello everybody. Good morning or good afternoon or whatever time zone you're in. I hope everybody's doing as well as can be expected in the current health and economic environment. I'm going to talk today about the changes in the demand for credit globally during this time of economic uncertainty and how to keep doing business and keep trading using tools including trade credit insurance. I understand there may be some people in the audience who are not in the United States. Most of my remarks are relevant to exporters and suppliers in the U.S. However, for people in other countries who are purchasing from the U.S. or from sellers in the U.S., this is a tool that you can share with them that they can potentially be able to work with you. If you're a company in another country who has sales to the United States or through subsidiaries in the United States, then that's also something that these remarks might be relevant to. So it's no secret that demand for credit's been increasing for some time. Customers, debtors, have been pushing back on suppliers for the last few years to get longer payment terms. Companies, for many years historically, a seller could dictate payment terms. But in the past few years, more and more customers, more and more buyers have been pushing back and saying, hey, look, you can put what you want to on your invoices for payment terms, but we're going to pay in 90 days, and taking more control of the credit decision-making process from the customer side. This has been happening not only with individual customers, but also in broader supply chains. For example, a few years ago, Boeing said to all of its suppliers, look, you can put whatever terms you want to on your invoice. From now on, we're paying in 120 days. And that had impacts not only on the direct suppliers to Boeing, but also down a very broad and deep supply chain, impacting many companies. But while demand for credit's been increasing for quite some time, since the outbreak of the pandemic and the economic impacts which have followed, this is the case even more so because companies are facing limited access to working capital. In particular, companies in other countries where their access to working capital was not as broad and deep as here in the U.S. in the first place. Here in the U.S. we've got the big money center banks, the regional banks, the community banks, the non-bank asset-based lenders, equipment leasing companies, receivables factoring companies, investment banking, private equity, and so on. This kind of depth and breadth of access to capital simply doesn't exist in many emerging markets and has really tightened in the past few years, even in Europe, between the challenges in the Eurozone and then the impacts of the Brexit. So companies are facing limited access to working capital from funding sources, from financial institutions and finance companies. And so they're looking to balance that need, that financing working capital requirement onto their suppliers by trying to get longer payment terms from their suppliers. Beyond the cash flow aspects, companies are also in COVID time facing diminished financial flexibility. Their balance sheets are being impacted. They don't have as much, or they have a growing amount of leverage, and so not as much flexibility for making payments as quickly as they might otherwise have been able to or willing to do. Your customers are getting paid slower by their customers in COVID time. So to the extent that your customers prefer not to pay you until they've gotten paid by their customers, or are unable to pay you until they get paid by their customers, that's putting pressure on you giving longer payment terms. Your customers are being forced to source goods through broken supply chains. If your customer has, say, 6 different suppliers that they have to get components or raw materials from, if 5 out of those 6 are doing okay still, but even one of those suppliers is in a country, in China or in India or some other country with lockdowns, or even a sector here in the US with shutdown, or some other complication that's impacting the ability to get that product, then your customer is simply not able to do their own throughput in manufacturing or whatever else they do with what you're selling them, and that can put more pressure on you to give longer terms as well, because it's going to take your customer that much longer through their own throughput. Your customers are dealing with employees who are operating remotely from their facility or working with physical distancing, which none of us are that good at yet. Yes, we know a lot more about how to work with remote operations and with social distancing than we did 3-4 months ago when this all started, but there's none of us that have years and years of experience. We're all still figuring this out. And your customers are contending with, with the same uncertainties that you are. We all believe there's going to be a recovery. Some of us, myself included, believe it may be a dramatic recovery because there's going to be an awful lot of pent-up purchasing demand. But nobody knows, whatever the pundits say, nobody knows when the recovery is going to come. Is it somehow fourth quarter this year, first quarter next year, second half next year? This uncertainty is profound. And again, your customers want to stay the course and do things now in terms of credit that are going to position them to be in the best place when the recovery happens. Beyond the reacting that you do to your customers' demands for credit, are the things that you proactively as a business do with credit to help grow your business and make sales. You've always done these things, but now the pressures are there even more so for you to proactively be using credit as a sales tool. Number one, to book orders while opportunities still exist. If you're fortunate enough to be in a sector that's still doing well, if you're in a sector where your customers are still able to place orders, you want to book those orders and make sales while the opportunity still exists. Again, in this environment of uncertainty, the companies to whom you're able to move product today may not be placing orders 3 months from now. So you want to take advantage of things while you can, and giving more competitive credit terms can be a way to do that. Furthermore, if you have competitors who are still out there competing against you for those scarcer order dollars, you want to use competitive payment terms to outdo your competitors. Giving longer payment terms and getting bigger orders may help you to produce more efficient quantities or to purchase more efficient quantities, making your business more profitable. And it helps strengthen your own throughput and your own supply chains by, having more dependable flow of orders that you're going to be shipping. Another important element in giving credit is getting your distributors, or for that matter, manufacturers you sell to take more inventory. One of the phenomena we've been seeing during this period in the last 3-4 months are our clients' distributors allowing inventory to dry up and then not investing in taking more stock. And the reason is because they don't want to stock up more inventory and then have to pay for it before they've been able to move it. The challenge, though, is this puts you in a tough position, because if your distributors are not stocking inventory like they were or like you need them to, then if they get orders, they're going to turn to you and expect you to get them product really quickly. And that means one of two things on your end, neither of them good. One is you're going to have to cut into your existing manufacturing flow and do an inefficient rush manufacturing run to fill that distributor's order, or you're going to have to have produced a lot of product and maintain a lot of inventory, which is expensive. Carrying inventory is expensive. What you want to do is you want to transfer that inventory carrying cost to your distributor, so that the distributor is the one who's got the product, and that's off of your balance sheet. And of course, extending longer payment terms enables you to do that, because you can go to the distributor and say, hey, here's what your stocking profile needs to look like, but I'll give you 90 days to pay for the goods you buy. Another important impact, especially now, of having your distributors stock more product, is getting your products closer to the end users, whether those are retail or consumers or whatever. Because in this time of broken supply chains, of compromised logistics, not having the product close to the customers can cost you, and having products nearer to customers mean they may use yours instead of a competitor's, or as opposed to not using it at all. So if you buy into these reasons why it's imperative to be reactive to customers' demands for more credit and longer payment terms, why it's important for you to continue being that much more proactive with your payment terms, then you need to deal with the challenges that arise from giving more credit and longer payment terms. And two key challenges are dealing with non-payment risks and working capital challenges. So first, to the non-payment risks. Obviously, there's always been the risk of a customer not paying when you give them open account payment terms. But the risks are becoming more acute now in COVID time, because so many companies, more than historically, have been filing for bankruptcy protection or otherwise becoming insolvent, being liquidated, going into receivership, or simply reorganizing as a way to control how to manage their excessive debts rather than going out of business. For your customers who are still in business, they may not be paying you or not paying you timely because of their own cash flow issues or working capital challenges, for all the reasons we were just talking about in the prior slides. Likewise, they may have balance sheet issues, which are making it difficult for them to pay all their suppliers, and they may be paying other suppliers or other creditors ahead of you. If your customer is being impacted by their own lockdowns or shutdowns or other quarantining in their geographic area, in their sector, or their suppliers are being impacted by that may be causing them to be unable to pay you. And then there's the direct impacts of the pandemic, directly impacting companies. But one of the things that we really have been cautioning our clients about, because we've seen this happen quite a number of times in the last few months, is you want to be careful not to look at everything out there through the lens of the coronavirus. Because even before 3-4 months ago, you had customers where there were fundamental reasons for concern about their credit worthiness. You had customers who would pay you slow just because of their payment morality, not necessarily because of, the pandemic, which hadn't hit yet. So while on the one hand, clearly you want to be sensitive to the challenges your customers are facing, directly and indirectly because of the coronavirus, you also want to watch out for the COVID-19 circumstances masking underlying credit problems or underlying issues in how your customers are paying you. And this is important because it drives the decisions that you make about giving credit, about how you go after a customer who's not paying, and so on. And then there are just the general economic conditions of supply and demand that are impacting your customers. And everything I've said so far is is true for the U.S. or for export sales, but for international sales, you also have exchange rate fluctuations and currency controls as challenges. More countries that have a limited amount of hard currency are exercising, conversion controls and transfer controls on hard currency, and other government actions and political events which are impacting or may impact your customers' willingness or ability to pay from other countries. Another big challenge as you find yourselves having to give more credit is the working capital challenge for your company. How long can you wait to get paid? There are really three factors contributing to these challenges. Number one, as we've been talking about, payment terms are getting longer. 90 days is the new net 30. Or for some sectors, it's even 120 days, some even longer, even 180 days. The economic impacts of the current situation and the downturn and the coming recession are pushing out trade cycles longer and driving demand for much longer payment terms. On top of this, your customers may be paying you slower, primarily because they may have less access to working capital, but also because cracks in payment morality are showing now. Companies that may have been paying you timely before may not be paying you on time now. And this may be because they're paying other people ahead of you. It may be because they're making a conscious decision. It may be because they're taking spurious advantage of the pandemic circumstance to tell you that, it's the pandemic that's keeping them from being able to pay, and so on. We've seen this quite a lot in recent times. It doesn't necessarily mean you're dealing with a customer who you shouldn't give credit to, but it's something to be aware of, that the fact, the customer payment behavior more than 3-4 months ago has to be relooked at again now in a different light based on what's going on and what's going to unfortunately continue to be going on for some time. You may have a customer who is a good customer, who's been your customer a long time, and they may continue to be your customer throughout this down cycle. So if we're in this economy that we're in now through, early 2021, say, and all throughout this period, you give the customer credit and they pay you every time faithfully, but they pay you 60 days slow beyond your invoice terms. That's a big impact to your working capital. So if let's say you're giving the customer 60 days payment terms on your invoices, and then on top of that, they're paying you 60 days slow. That's 120 days DSO, days sales outstanding, how long you're waiting for your money. So unless you have a heck of a lot of working capital of your own, how are you going to keep paying the light bill? How are you going to keep from furloughing your workers who you want to keep on? Above all, if you do manage to keep getting new orders, how are you going to have the working capital to be able to fill those orders? And so these first two components are being juxtaposed against greater difficulty in finding financing for accounts receivable. Banks are facing regulatory challenges, and banks and other lenders face credit challenges to financing receivables now, especially when those receivables all of a sudden are arising on invoices that have longer payment terms than they did before, when these are receivables that are increasingly being characterized by past due paying by the customers, where there are more concentrations of risk because, some companies that were selling to 30 customers before, that has now contracted to maybe only selling to 5 of the biggest customers. So there's more concentration risk. And generally during this downturn, one of the things that banks are understandably concerned about is what happens later if regulators come into the bank and do an audit and ask the question, what were you thinking to lend money to this borrower against these receivables when the payment terms were so long, when some of the receivables were being paid slow, all during what everybody knew was a looming recession. So, I think banks want to lend, lenders want to lend, but they're facing a lot of challenges in doing so. As we look around the world, the only major economy that's looking at growth for their 2020 GDP projection is China. And that's a way smaller growth projection of just 1% than the 7%, 8% having been predicted pre-COVID. Looking at other parts of the world and some of the other major markets, Europe at 8% for 8% down, negative GDP growth for Germany, the biggest engine in Europe, 13% drop or 13% negative growth for France, Spain, Italy, 10% off for the UK. And even in emerging markets, Mexico off by 10%, negative 9% growth projected for Brazil. And likewise, most of the other key economies in the world, let alone lesser economies in size that, I haven't listed here, but, where the shortfall may even be considerably larger. Now, there's still a heck of a lot of international trade going on, trillions of dollars. But these kinds of shortfalls are unprecedented in recent times and put a lot more challenge on granting of credit and payments. So what can be done by a supplier who wants to keep doing business and has opportunities to keep doing business to manage the demand and to manage credit in these times? Number one, carefully evaluate or reevaluate, and we'll talk about this in a minute, customers' credit worthiness. And then on the basis of that analysis, extend reasonable credit terms, reasonable for them and what their needs are, reasonable for you and your own prerogatives. Number two, obtain credit insurance to protect the accounts receivable arising from those invoices against non-payment risks. And if you find yourself short on working capital as a result, to monetize the receivables with financing from a bank or some other lender, because if the receivables are insured, banks and other lenders are going to be much more likely to consider financing them because the insurance makes the receivables a much more attractive asset. I'm not going to pretend that it's easy to go back out to customers, especially customers who you've been dealing with for some time, and ask them for credit information as if they were a new customer to you. Even in the United States, that's a tough ask on relationships. In many parts of the world, particularly in Asia, that could be a killer for a relationship because the maintaining of face or the loss of face are huge considerations in those markets. But to the extent that you could get new information on your customers, you would want to. And you should think in terms of that as a philosophy, even if it's not practical in some cases. If you have an ongoing customer who you've been selling to for years, but you haven't given them credit in the past 3-4 months, and some other supplier has given them credit in the past 3-4 months, it would be very useful for you, before you give that customer credit today, to know how they paid that other supplier. So to the extent there is any way for you to get information from other suppliers who sell to your customer about how they've been doing since the outbreak of the pandemic, that can be very useful information. Of course, the most important trade reference is your own ledger experience in terms of how the customer has been paying you. And you want to keep a close eye on that in these times, even closer than you did before, really scrutinizing your receivables from the customer before you make each new shipment to them. To the extent that you rely upon customers' financial statements for making credit decisions, this has been a challenging season for a couple of reasons. Number one, to the extent that your customers have their financial statements audited, audits have been pushed back. Companies that were getting their audited financial statements output typically in the past in, say, March or April of each year, because physical audits have not been possible to conduct because of physical distancing and other challenges now. Many companies are just getting their audited statements out now, or it may be later in the year before their 2019 audits become available. Further, what do December 2019 figures tell you about how companies' financial condition is in COVID time? So even first quarter results, March 31 interim statements don't really tell us because things were just really starting to get serious then. June 30 figures are starting to come out now for companies that publish quarterly or semi-annual interim statements, and it's going to be very interesting to see what kind of results are there, although for many companies, depending on their own trade cycle, even the June 30 figures won't tell us the whole story because the impacts maybe are not being fully felt yet. Credit bureau reports, I don't know what you use. I mean, Dun & Bradstreet or Credit Safe or SkyMinder or FCIB or Graydon or any one of the other many credit reporting services that are national, or the ones that are country specific like CRISIL reports in India and so on. Some of the bigger credit reporting agencies have started adding to their reports a COVID score, like some kind of some kind of mechanism or some kind of tool, supposedly, to like an algorithm to try and help you determine how likely it is your customer will pay their debts timely, and how their creditworthiness is impacted by COVID. In our opinion, these are really just sales gimmicks on these credit reports. It is way too early, and there are way too many variables for any kind of realistic credit score revolving around COVID impacts to have come out. Having said this, credit bureau reports, as always, are useful as tools, perhaps not as primary credit decision-making tools, but at least as secondary tools to help you triangulate in on the information that you develop on a direct basis on your customers. Industry creditor groups are very important, whether it's as part of organizations like the National Association of Credit Management or the Credit Managers Association, or just ad hoc creditor groups within a given industry or a given sector to be able to compare notes about customers and about countries they're selling to. There's more information than ever available online. Information and data and articles on customers and on the sectors your customers are in. And of course, for making credit decisions, you also now have tools like Zoom and WhatsApp and so on, where you can, through the lens of a phone or a laptop, conduct a personal site visit virtually and have your customer show you what's going on in their facility. So, for example, you can compare the activity level with the last time you went in person, say a year ago. So you can have some kind of frame of reference for what's actually going on at their facility, as well as just looking them in the eye, having a dialogue via video. If all of us were doing business with companies that were investment grade, publicly traded companies, and we could look at their debt ratings and say, this is still a triple A, or it's dropped to a double A, and so on like that. It would perhaps make the credit decision-making job easier, although even those ratings need to be called into question in COVID time. But the reality is most of us are, dealing with middle-sized corporates or maybe even smaller companies in other countries or in our own country. And so, as always, making credit decisions is a juxtaposing together of less than complete information and having to make some judgment calls. So now to talk about credit insurance as a tool for trying to continue managing this credit demand and the risks associated with it. I'm not going to spend a lot of time in this presentation explaining what credit insurance is. I'll take a couple of minutes now to do so. If you want more information about credit insurance as a product in more detail, we can talk about that afterwards or offline. But I'll just give a brief introduction here because I want to focus more on what's happening with credit insurance during the past 3-4 months and what to expect in the months to come, what it's actually doing and how it's actually working, what's actually happening in the industry. So credit insurance is a product that exporters can buy, and this can also work for domestic. So anything I'm saying here about export also can go for, say, US to US sales. It's an insurance policy that a seller can buy that protects accounts receivable against non-payment risks. If a company has a credit insurance policy and one of their customers is covered under the policy and that customer defaults, meaning the due date came and went and you didn't get paid. So if the invoice payment terms said net 60 days and we're at day 61 and the customer hasn't paid, that's a loss under the policy. And if that debt cannot be collected, then the insured party can file a claim and get indemnified by the insurance company. Export credit insurance enables companies, therefore, to extend competitive payment terms with confidence, knowing that one way or another they're going to end up getting paid, and to continue making sales even during an economic downturn like we're in. It increases the profitability of a company's sales. For example, like I described before about helping you to extend more progressive terms to distributors to get them to stock more inventory. And it enhances borrowing capacity. So banks and lenders who might otherwise find it challenging to lend against accounts receivable as collateral, if those receivables are insured, lenders tend to find the receivables to be much more attractive. So in summary, credit insurance is a risk management tool because it protects AR against non-payment. It's a sales tool that helps companies extend more competitive payment terms, and it's a financing tool. Credit insurance policies can be written to cover all of a company's turnover or a reasonable spread of risk amongst its customers. It is possible to buy coverage on just a single customer or even a single transaction, but it needs to be a particularly creditworthy debtor in that case. Otherwise, insurers are looking for some kind of spread of risk, and we'll talk about more about how this is impacting in COVID time in a minute. Premiums for credit insurance are not expensive. They are a fraction of a percent on sales, a fraction of a percent of invoice amounts. So basis points, fraction of a percent, pennies per $100 invoiced. Under a credit insurance policy, claims can be filed pretty much right away if the reason the customer didn't pay is because they went bankrupt or otherwise became insolvent. If a customer is still in business but is just paying you slow, credit insurance policies do not make you bring the hammer down on your customer right away. They tend to allow a period of up to several months, sometimes up to a year, before you would need to file a claim if you're going to. You don't have to wait that long. You can file the claim sooner, but the insurance policies recognize that if you have a relationship with a customer, you may want to try and work things out with them before you would bring the hammer down by filing a claim. Under a credit insurance policy, Customers need to be approved. Each customer needs to be approved for a credit limit. There needs to be some kind of credit discipline. However, that varies from insurance company to insurance company in terms of how they look at that. Some insurance companies will use their own data, their own databases and their own algorithms, or financials, trade references, credit reports, and other things, other information provided by the insured party to make credit decisions about insuring an insured's sales to each customer. On the other hand, there are insurance companies who are a great deal less interested in who the individual customers are, and they're more interested in who the insured party is. Meaning, if the insured party, the company buying the policy, has good, strong credit procedures and a good track record and so on, the insurance company may give the insured party the flexibility to just keep making its own credit decisions, and as long as some mutually agreed rules are followed for the extension of credit, then the insurance company does not need to be looking at each individual customer, but rather is underwriting the credit procedures and practices of the insured company. In the United States, there has been a significant growth in the number of insurance companies who are writing credit insurance policies. Our company's been brokering credit insurance for 27 years. When we first started, there were maybe 4 or 5 insurance companies. Today, there's close to 30 in the United States. You've got multi-line carriers like, meaning companies, insurance companies that have every kind of insurance, personal lines, commercial lines, property, casualty, life, etc., but who also write credit insurance. Examples are AIG, Chubb, Hartford, Allied World, Zurich, and so on. There are specialty insurers who also have multiple different lines of insurance, but they're specialty lines, like they'll have a credit insurance group, a surety group, and so on. These include Great American Insurance Company, Houston Commercial Casualty, Liberty Mutual, Markel, and others. There are what are called monoline underwriters, meaning insurance companies that the only line of insurance they write is credit insurance. The 3 most well-known globally are Euler, Coface, and Atradius, headquartered in Germany, France, and the Netherlands, respectively, but they've been in the United States a long time. There are some newcomers to market as well, including receivables. There are the Lloyd's syndicates, the Lloyd's of London, of which there are about 50 that write credit insurance policies, and a growing number of those are available in the U.S. now on a surplus lines basis. And then there are the export credit agencies in each country. In the United States, the Export-Import Bank, which has been staying the course a little bit more robustly than some other and private sector insurance companies, because their mandate is to assist exports and to support international trade rather than having a commercial reason for being. And they tend to remain open a bit longer when the private sector markets close. However, of course, the Exim Bank program is available only for exports of products made in the USA. So what's happening in the credit insurance industry early in the downturn? And I say early in the downturn because even 3 or 4 months in, regrettably, these are early days. We're gonna be in the soup easily for the rest of 2021. Rest of 2020. So get used to it if you're not. So credit insurance has been used much more extensively in other countries in recent decades than it has in the United States. There are a number of political and cultural and regulatory reasons why credit insurance has been used much more by companies in Europe and in Asia. However, that is starting to shift now. We wouldn't have wanted the pandemic to come, but the pandemic is giving rise to a big increase in demand for credit insurance in the United States. And a lot more companies here are obtaining coverage. After the 2008-2009 recession, there were a lot of claims that the insurance companies paid. Since then, the claim volume has been relatively level. A surge is anticipated. We in our portfolio haven't seen a huge uptick. We've seen a little bit of increase in the past few months, but not a huge surge in claims, but it still may be yet to come. The thing I can't emphasize enough is the extent to which the credit insurance market has turned overnight from a buyer's market into a seller's market. The big increase in the number of insurance companies in the U.S. market who are offering credit insurance that I described in the last slide has given rise to a big increase in capacity. And sort of when supply goes up more than demand, it makes for a buyer's market where companies who are shopping for a credit insurance policy are the ones who have the cards in terms of negotiating policy terms and conditions, negotiating policy premiums, and so on. That is absolutely no longer the case. In the past 3 to 4 months, this has become completely a seller's market, where companies really need to work hard to get an insurance company to give them a quote. Insurance companies are still underwriting. We booked more policies in the second quarter than we have in any quarter in our existence. So there's definitely a lot of underwriting still going on, but the insurance companies are growing more cautious as recession looms, and it's not known how long policies are going to continue being issued. Ex-Im Bank, like I said, the government agency, is staying on course more, but even with Ex-Im, capacity is not unlimited. So if a company does not have credit insurance and they're thinking about getting credit insurance in this downturn, rather than taking a wait-and-see attitude, this would be a good time to get cracking. So what are the best practices for applying for a credit insurance policy now? Number one, come into the insurance company applying to cover a reasonable spread of risk. Either all of one's receivables or a reasonable portfolio of all of one's largest buyers. Insurance companies are not inclined to issue quotes today on adverse selections of debtors. They're not really interested in seeing cherry-picked submissions. It really helps to include with an application to a credit insurance company, a cogent cover memo. It doesn't have to be a book, just a page, a few paragraphs, something describing how the coronavirus is impacting your company and your industry that you're in, and so on. Insurance companies are trying to make intelligent decisions. They don't want to make stupid decisions during a time that they don't have any precedent for. This is terra incognita for everybody. So whatever you can do to help the insurance company think that they're making a smart decision to get into bed with you as a potential insured is going to help them. You want to give clear explanations for any accounts that are past due at the present time, and give descriptions of whatever credit procedures and policies you have that are favorable, that are going to make the insurance company feel comfortable with you. And you want to have reasonable expectations about what kinds of terms and conditions that the insurance companies are going to be including in their quotes, because any coverage right now is better than no coverage. Policy quotations now are manifesting more in the way of risk sharing. Insurance companies are looking for higher deductibles, meaning annual deductible, the total dollar amount of losses that need to be incurred before the insurance starts indemnifying, and in some cases lower indemnification percentages. So a policy that in the past might have offered 95% coverage, now maybe they're quoting 90% coverage. So still, the lion's share of the risk is being burdened onto the insurance company, but they're looking for a bit more risk sharing by the insured party. Credit insurance premiums are going up. They're still in many cases less than 1% of invoice value, like we talked about earlier. Ex-Im Bank is still holding the course on its current rates, but these may go up, and in some cases have gone up already, but not as much as in the private sector. Buyer credit limits continue to be approved both by EXIM and the private sector, but this is getting more challenging. Buyer credit limits can either be, as we talked about earlier, on a named basis, one by one, or with discretion given to the insured party. When you're coming in for getting an individual customer approved, you can go to an insurance company and just throw the name of your customer at them and say, hey, I want to give this company $500,000 of credit on 60-day terms, may I? And expect the insurance company to figure it out and give you an answer. I'm not saying that that is an impossible way to get credit insurance today, but it's not what we're recommending based on what we're seeing from the underwriters. You optimize your chances of getting your customers approved for credit by coming in with a little bit of a package. If you can provide your customers financial statements, so much the better. Other credit information on the customer. And again, a few lines of commentary from you can make a huge difference to an insurer. Some notes about the credit, a little bit of a credit memo, information about your past ledger experience with the customer, the pandemic's impact on their business and their industry, and information about the underlying trade transaction. Is your product one, for example, that is essential to the customer, so it gives you leverage in terms of being able to get the customer to pay? Is this a one-off sale, or is this ongoing business where the customer relationship is something you'd be able to leverage to help you get paid? If you can get discretionary credit limits from an insurance company, clearly that's something which you want to try and get now. Meaning where the insurance company is giving you the ability to make credit decisions. As credit insurers become more and more nervous about this or that sector or this or that debtor, if you're the one if you're the one that your credit insurance policy is enabling to make your own credit decisions and still be insured, this is a very powerful tool because the insurance company can't come in and say, take that away, because you're making your own credit decisions per the terms and conditions of the policy. Even if this costs you a little bit more for the insurance policy, it's worth it, because the key thing is that you get to keep being able to sell on an insured basis to your customers. Credit insurance claim filing is not really different now from how, in COVID time, from how it has ever been. When you have a claim, you need to file it within the policy's claim filing window. A policy spells out clearly what the deadline is, how many months past due for filing claims. Some insurers have been extending that period of time, but there's still a hard date beyond which claims can't be filed anymore. And again, this is usually months out from the original due date. But you need to comply. You can always come in and ask for an extension up until the end of the claim filing window. But if the claim filing window, for example, is not more than 8 months past due to file a claim, don't come in at 8 months in one day. Come in ahead with whatever extension request. Ideally, there should be dialogue following a loss between you and the insurance company, and this is something that we certainly facilitate. You or the insurance company is going to be in control of collections until the point where you file a claim, and you want to make sure that that's coordinated. You need to, no matter what, before or after you file the claim, you need to cooperate with the insurance company, and between you do everything possible to help minimize the loss. When it does come time to file the claim, there's a claim form. You fill that out, just describing what happened in the claim, and you provide copies of purchase orders, invoices, bills of lading, etc. All the documentation and correspondence relating to the orders that you're claiming, the invoices and receivables that you're claiming on. At the point where the insurance company is going to pay you on the claim, you sign a release and sign over the receivables to the insurance company, because they're going to go and try and collect. That's not your problem anymore because you've been indemnified under the policy. But this is one of the things that makes credit insurance different from other kinds of insurance. With, for example, homeowners insurance, if a house burns down, there is zero future scenario under which the house is going to unburn down and the insurer is going to recover anything. They're just going to have to take the loss. With credit insurance, credit insurers have a bigger stick than you do for being able to collect and recover, and they have a pretty good track record on recoveries. So, this is an important element of credit insurance to understand. Again, it doesn't impact you after you've been paid on the claim, because once you've been made whole by the insurance claim payment, it's the insurance company's issue to collect and how they go about that and trying to recover. Getting credit insurance claims paid is a function of policy compliance, including making sure that your exports are eligible under the policy, or the sales you're making are eligible, which is determined by your documentation, your POs, your invoices, etc. That you've got buyer limits in place for each customer, like we talked about, whether it's the underwriter's approval of your own credit decision. That you've paid premium, whether it's required monthly or annually, or however your policy is set up. That you've been in communication with the insurance company about any past dues that you haven't filed a claim on yet. And like I said, that you've filed your claim within a policy's claim filing window. Complying with a policy is eminently achievable. A credit insurance policy is no greater than the sum of its parts. Credit insurance policies have more moving parts than other kinds of insurance, but it's no greater than the sum of its parts. It is possible to read your policy and understand it. These are not long documents. A typical credit insurance policy is maybe 8, 9, 10 pages long. And they're reasonably transparent in how they're written. Of course, on top of those pages, there are the endorsements and the declarations and so on. But it is possible to, and it's essential to, it's imperative that you read through the policy and understand it so that you can comply with it. Complying with a credit insurance policy is not that different from running a business with cogent credit and collection procedures. They really are, most of the requirements in the policy are consistent with running a business's credit practices in a cogent way. And a company that has a credit insurance policy will find itself, in principle, in compliance in most ways if it will follow this one key guideline, which is to extend credit under the credit insurance policy with as much care as if you didn't have a credit insurance policy. So a brief word about our company, so you understand where I'm coming from with my comments. We started out in 1993 arranging cross-border equipment financing. We used credit insurance behind a number of the transactions that we were arranging financing for, and thought, well, we should internalize this insurance into our skill set. And so we got licensed for the insurance and fairly quickly started facing demand just for credit insurance. So flash forward to today, the biggest portion of our revenues comes from brokering credit insurance now, both accounts receivable insurance within the United States, as well as export credit insurance for transactions, where our clients are selling to customers in other countries. We also specialize in political risk insurance for sales to foreign governments, as well as protecting assets that are located in other countries, as well as other forms of insurance for international trade, specialized surety bonds for international business, and also non-insurance credit risk management tools like AR put options and so on. We still also do arrange cross-border equipment loans and leasing and other types of supply chain finance for international business. We're headquartered in the United States in Los Angeles. We also have offices in New York and several other U.S. cities. And then sister companies, affiliates in London and Singapore, enabling us to do business with clients that are multinational, as well as to access credit insurance underwriting markets all around the world. So that concludes my my prepared comments. I thank you very much for your attention. And if anyone has any questions or feedback on how your business is faring in COVID time, I'd be very happy to hear that or to answer any questions you've got.
Thank you for that presentation, Gary. So if you have some questions, you can type in your question on the Q&A tab right now. While waiting, I'll just start a poll. So yeah, so you can start asking question right now, and so that the presenter can address the question. Um, Also, if someone is raising hand, let me just try if you'll be able to speak. I think it's Faris. One second. Let me see if it's working. Mr. Faris, can you try to talk if you'll be able to? I think you have some question. Hello, Mr. Faris. I don't know if you'll be able to speak. All right. So I don't see any question right now. Though the email address of the presenter is here, info@meridianfinance.com. If you have any questions in the future, you can feel free to email him. Also, this webinar is recorded, so we will be sending the link of the recording so that you can review it, and you can share it to your colleague also. And if you have any question after hearing the recording again, please reach out to me or to Mr. Gary, so that he can answer your question directly. Um, yes, we will be sharing the presentation. Mr. Mendel, can we share the presentation to the attendees?
Sure.
Okay. All right. So we will be sharing the presentation to the attendees, and so that you can review it. And we will also include his direct information and email address on the email. So, any other questions? I think that's it for today. So thank you so much for attending the webinar, and we hope to see you again on the next webinar in the future. And again, if you would like to be a member, if you're not yet a member of International Trade Council, please reach out to us and we will definitely help you. Thank you so much for your time, and you all have a wonderful day. Thank you, sir.
Thank you.